Hello, this is Doc Severson for the Night Report for Tuesday, February 21st. So here we sit the day after a 3-day weekend and the S&P goes up another 14 handles. Now I'm starting to hear a lot of panic, a lot of hyperbole, like the market's broken, what's going on here, how could this possibly be happening? And so in today's report, I've got really 3 things that I want to bring up. So 3 statements, and then I'm going to wrap it up with sort of my suggestions in terms of how we can trade this market going forward. So statement number 1, traders think that this current move that we're in is extreme, it's overbaked, it's overdone, it's unsustainable, it can't possibly go on any further. Well, just for some historical perspective, right now, the current move is good for about, we've gone from a low here of about 2084 or so, and we're sitting up here at about 2367. So that's about a 283 point move, plus or minus or so. And it's in this very characteristic kind of S-shaped curve here. And the reason why this occurs is because you get the initial short covering off of the bottom, right, where too many people were way too short around the election time. And so a lot of the bulk of the gains comes from that. And then you get into this sort of fat period in the middle here as the market sort of recovers from exhaustion, builds up energy for the next move, and then you get the final chase after the market move. Okay, so this is all actually very, very normal. But as far as the actual number here of 283 points, this is like right in line with some of the major moves that we've had over the past several years. So one that comes to mind right off the bat was this crazy market that we had here in 2013. So a lot of the same things are going on around that time where we really saw a shift in the market. Notice how the market used to operate before this. During a typical bear or bull market, we'd got a lot of choppy behavior, and then eventually near the top of it, it would sort of go ballistic. Remember that S-shaped curve that I talked about before. Same thing happens on every time frame. Okay, so we got this move in 2013, and everybody was thinking that, well, the market's completely broken. This can't continue to go on. Well, look at this. It tacked on more gains in 2014 as well, too. So it had plenty of potential to go. Markets can do whatever they want to do. It's just that we lack the imagination to understand what's happening beneath the surface. So just as a comparison, the initial move that started here, and it was right near the end of 2012 when this started. So the initial move that went from the end of 2012 until the spring of 2013, when this thing finally took a little break for a few weeks, that was good for 344 points. So that's a full 50 plus points more than what we put on with the current move. So we've had other moves of similar magnitude as well too, such as the move at the end of 2014 that came up here. That was good for almost 300 points as well too, as well as last year. Around this time last year, we had ultimately what was good for 292 points. So our little 283 point move that we have here is perfectly within the limits of normalcy as we've seen in the market really since it changed to a different character in 2013. So that's point number 1. Traders think that this is extreme, like this has never been seen before. No, we've seen this movie before. It's no big deal. This is really no different than any other of these moves that we've had over the past 4 years. So that leads me to point number 2, is that what I'm getting a sense of in talking to traders is that they think that, wow, when this move is over, it's going to be Armageddon. It's going to be Armageddon out there. It's going to be the worst market that you've never seen selling like we're about to get, because this market really deserves to be taken over a knee and spanked. Okay, so let's think about this for a minute. Let's compare this current market to some other bubbles, and probably the worst bubble that I can think of that's occurred over the last 20-some years has been the tech bubble, the Nasdaq tech bubble. It was back here in, basically topped out in 2000. All right, so let's change this around. I'm going to change the weekly chart around to look at 20 years, and so we can get some better detail on it. So I'm going to go back over here, and let's go back 20 years ago and kind of zoom in on what's happening here. Now, certainly that was one finishing rally that we had here at the end of 1999 into 2000. Okay, but what happened was, if you'll look at this, yes, we had a lot of volatility. It certainly went up as well as it went down, right? But all of this movement took months to occur. Did we get some strong selling at the very beginning? Yes, we did, but it didn't make new lows. In fact, that was nothing more than a higher low at the time before we finally turned around and made a lower high, double top lower high here months later. And that was all the way in the fall of 2000. So it took almost a year for this battleship to turn around and start to head lower here. So did it have an initial strong move to the downside? It certainly did. But it did nothing more than create a higher low. And in fact, we can look at a lot of the moves that we've seen over the past several years, and even the ones that were more recent, like the 2011, the disaster that we had there, as it looked like, oh my gosh, Greece was going to fall out of the European Union, and the United States got downgraded in terms of its debt. You know, what could be worse than that? Well, it was just another higher low. Even the correction period that we had here from mid-2015 to around this time last year, 2016, again, higher lows here, higher lows, nothing more than higher lows on the monthly chart. Okay, so just from a perspective, is that, again, my point number 2 is that traders think this is going to lead to Armageddon when this thing finally corrects. And I would say at this point, all I would say is that when we finally do get some selling, all it's going to do is create a larger range with another higher low. Yes, that red candle is going to be really, really scary when it finally comes out. But in the perspective, in the larger picture of things, it's no big deal. We're going to look at this red candle at some time in the future when it comes out and say, well, what was all the fuss about? That's just a normal higher low setting up. It will come quick. We will probably see Jim Cramer coming out on the Today Show to try to calm everybody down. But again, in the bigger picture of things, it's all going to be very normal. Now, the last point I want to make here, before I get around to my own recommendations, is that traders tend to be their own worst enemy in a market like this. So we get the attitude that we say, well, this can't continue, this can't keep going higher, and we tend to either chase it higher by shorting, and then at some point the pain gets to be so great that we have to bail out ourselves, buy back the shares, buy back the position, turn down our hedge, and we create our own problem here. And it's not just each one of us individually, it's each one of us times millions of other traders that are doing the exact same thing. And this is why we get these runaway moves. And then, of course, you've got funds that are underperforming the S&P 500 that are being forced to close their nose, pinch your nose and just jump right in because they have no other alternative. They're getting pressure from their own customers saying, you can't even keep up with the S&P 500. What am I paying you for? And so they have to dive in. And so this whole situation creates itself. We've been through this before. We've seen this movie before. We know how it's going to turn out. The only issue here is when this thing finally stops. And I don't know that. You don't know that. None of us know when this will stop. But typically the answer to that is that when traders quit trying to short the top is going to be the end of this fuel that keeps getting pushed to the upside. So now let me finish up by kind of wrapping this up. How do we trade something like this? What do we do? What do we do at this point? Well, what I would say is at this point, we are now getting a little bit long in the tooth with 283 points. Yeah, we may have as much as 50 points of potential in here, if we're going to be like 2013. Or we could be like last year and maybe have another 9 points to go before this thing. There is a lot of symmetry in the S&P 500. So a typical 300-point move, we're almost there. What I would do is, if you're long and if you've done well through this move, maybe you didn't catch the exact bottom, but maybe you've been selling puts along the way, maybe you've got some call spreads in place and you're doing well with those, maybe even long call options, who knows? Now might be the time to start sliding the noose up on these positions, making sure that they don't get away from you. There's nothing worse than having a position well in the green, all of a sudden fall in the red. So I'm personally starting to put the noose on some of these positions so that they don't get away from me, or perhaps sell into strength and start to lighten up the long delta exposure. Secondarily, right now, this is not really the time to short this market, but what we can do is we can start to put on positions that have duration over direction. So I can start to layer in some short delta positions. I'm not going to be right out of the gate, and I might be wrong for the next 30 days or so. But what I can start to do is start to work myself up into a larger and larger short delta position. Now, I'm not going to have great expectations for this. Again, all I'm expecting from this is perhaps we're going to just set up a slightly larger range out of here. Slightly larger range out of here. Maybe it's going to come down to 2,200. Boy, that would be actually, more than I could hope for at this point. But, it's going to be somewhere on the order of a 100-point range or so that we're going to set up. I mean, this would be very normal, very typical, similar to what we saw here in the fall before we had the election. About a 100-point range here that we set up. In fact, this one, it was about a 100-point range here on the S&P. And we're due for another one at some point. Now, when this will happen, I don't know. But if I start to layer in short deltas at this point and start to thin down my long deltas at this point, I'll be perfectly positioned. You're never going to catch the top of a market like this. You have to set up your positions duration over direction and not trying to pick the top, because as we know, market bottoms are an event. Market tops are a process. Market tops are a process. Even if that market top leads to the next high from here. So range expansion leads to range contraction. This is all we're doing, is anticipating the next contraction, and that's it. That is it for tonight's report. Have a great night, and we'll see you tomorrow.